Most people think the financial system is just money moving around. But the real story is incentives, rules, and who gets paid first. If you don't know the rules, you end up playing someone else's game, and you don't even realize it. So today, we're going to slow it down. No hype, just a clear map of what's happening and what you can actually do. This is The Passive Path. I'm your host, and this episode is about the casino feeling people get when they look at the economy and markets, not in a conspiracy way, in a incentives and structure way. And I brought a fictional guest today. They're not a real person, not a guru, not a credential, just a character to help us think clearly. Welcome, Morgan.
Thanks for having me. And I like that framing. We can use the casino metaphor without turning it into a dramatic story. The point isn't that everything is rigged and you're doomed. The point is that there are house rules and most people never read them.
Let's start there. When people say it feels like a casino, what do they actually mean?
They usually mean two things. First, outcomes feel random. Second, some players seem to win consistently while everyone else rotates through hope and disappointment. In real casinos, the randomness is on purpose, but the expected value is not random. The house has a small edge, repeated millions of times. In finance, the edge comes from structure, fees, timing, access to cheap money, better information, and the ability to survive volatility. That's the house edge.
So it's not that markets are fake, it's that the experience depends on where you stand.
Exactly. A storm feels different if you're on a yacht, a fishing boat, or a swim ring.
Okay, you use the phrase house rules. What are the big rules people miss?
I'd group them into 5: compounding, inflation, risk transfer, information, and behavior. Those 5 explain most of the pain people feel, and most of the advantage that disciplined, boring strategies create.
Before we go into the rules, I want the map. In the transcript idea, there's a pyramid of levels of players. Can you translate that into something practical?
Sure. Think of 5 broad roles people play in the economic system. You can move between them over time, but most people are stuck in one role because they never plan the transition. Role 1, system shapers. That includes big institutions, major owners of capital, and people who influence policy and regulation. Not necessarily villains, but their incentives and tools are different. Role 2, builders. Entrepreneurs, founders, operators who create new products, new distribution, new models. Some become system shapers, most don't, but they do change local rules in their niche. Role 3, earners. Employees and professionals trading time and skill for income. This is the largest group. Rule 4, market participants, investors and traders. This includes long-term index investors and also short-term speculators. Same arena, totally different game. Rule 5, hope-based players. Lottery, extreme leverage, one trade to save my life behavior. It's not just lottery tickets, it's any strategy built on a miracle outcome.
That's a clean map. And you're saying the casino feeling spikes in rolls 4 and 5?
Yes, but role 3 can feel like a casino too, because inflation, job insecurity, and skill obsolescence can make hard work feel like running on a treadmill.
Let's hit that. People work, they save, and they still feel behind. What's going on there?
2 forces. First, inflation, especially in essentials like housing, energy, childcare, education, and food. Even if the official number is moderate, your personal basket might rise faster. Second, the income ladder is not smooth, it's lumpy. You don't get rich by getting a 3% raise every year. You get rich by making a few big jumps. New skills, new role, new geography, new leverage, or new ownership. If you stay in the earner-only lane, your ceiling is usually lower than you think. Not because you're not good, because the system rewards ownership and scalable output more than it rewards time.
So a key takeaway is, income matters, but ownership changes the math.
Yes, and that leads right into rule 1, compounding.
Let's do it. Compounding sounds like a cliche. What do people misunderstand?
They misunderstand the direction of compounding. Compounding is not automatically your money grows. Compounding is whatever has a growth rate will dominate over time. That applies to assets, but it also applies to debt, fees, and bad habits. If you carry high interest consumer debt, that's compounding just working against you. If you pay high fees for decades, that's compounding just leaking.
Give me a grounded example. No fairy tale.
Sure. Imagine two people, same salary, same intelligence. One person invests a small amount consistently into a low-cost diversified fund. The other person keeps money mostly in cash because cash feels safe. In year 1, they look similar. In year 5, still not dramatic. In year 10, you start to see a gap. In year 20, the gap becomes life-shaping. Not because the first person is a genius, because the system pays you to be consistent when compounding is on your side.
And inflation is the enemy if you sit still.
Right? Inflation is like a slow tax on cash. Cash is useful for stability, but it's not a long-term wealth engine. You need some cash for emergencies and near-term spending. But beyond that, you need productive assets. Businesses, broad equities, real estate done safely, or other assets that have a reasonable chance to outpace inflation over long periods.
Let's pause and make that practical. What does some cash mean?
I like a simple rule. Keep a true emergency fund, 3 to 6 months of core expenses, sometimes more if your income is volatile. That money is not there to grow, it's there to prevent a bad month from turning into a bad decade. Then keep known expenses cash, taxes, insurance, a planned move, a big purchase in the next year. Everything else gets a plan, not vibes.
Not vibes is a good line. Okay, rule 2, risk and return. People hear higher return means higher risk, and then they do something reckless.
Because they treat risk as a single number. Risk is multi-dimensional. There's volatility, risk, prices swing, there's permanent loss risk, you never recover. There's liquidity risk, you can't access money when you need it. There's career risk, your income drops at the same time markets drop. There's leverage risk, small moves wipe you out. Sophisticated players don't just chase return, they design how risks land. They try to avoid all my risks happen at the same time.
That sounds abstract. Translate it.
Okay, consider 2 households. Household A, single income, unstable industry, high debt payments, no emergency fund, and they invest aggressively. If the economy slows, they risk job loss and market decline at the same time. That's correlated risk. Household B, dual income or stable income, emergency fund, manageable fixed costs, and they invest steadily. If markets drop, they can still pay bills and keep investing. That's survivability. In finance, the best edge is staying in the game.
That's a theme on this channel. Survive first, then grow.
Exactly. Now, the transcript idea mentions that top players transfer risk to others. That can be true, but we can discuss it calmly. For example, businesses use limited liability, investors diversify, banks structure products, insurance exists to move risk. Sometimes this is good for society. Sometimes it's abused. But for you, the lesson is don't be the person unknowingly holding the worst risk. If you don't understand what you're holding, assume you're holding the bad end of the deal.
So the practical move is simplify.
Yes. If your goal is long-term wealth, simple beats clever, low fees, diversification, long horizon, a plan for downturns.
Rule 3. Information. People believe the market is a fair battlefield.
It's a battlefield, but it's not symmetric. Some players have speed, some have better data, some have relationships, some have teams. The average individual investor is not competing against their neighbor. They're competing against professionals, algorithms, and incentives they don't see.
This is where people spiral into it's all manipulation. How do you talk about this without going off the rails?
By separating unfair advantages from hopelessness. Yes, informational advantages exist. Yes, certain players see more. Yes, markets can be influenced by liquidity, narratives, flows, and policy, but you don't need to beat them. You can choose a game where their edge doesn't matter much.
Which game is that?
Long-term diversified investing, owning a slice of productive businesses through broad index funds or diversified portfolios. In that game, speed and secret info are less important. Time and costs matter more. Compare that to day trading. Day trading is exactly the game where speed, information, and emotional control matter most. It's the hardest version.
So for most listeners, don't day trade is not moral advice, it's game selection.
Exactly. It's like choosing not to play chess against a grandmaster for rent money. You can still learn chess, just don't stake your life on it.
Let's talk about a common trap, insider tips. People think they have a friend who knows something.
Most inside tips are just stories. If you actually had real privileged information, it would be rare, dangerous, and often illegal to trade on. And even then, timing can still destroy you. A safer truth is this: if you're hearing a hot idea late, your exit liquidity, you're the person someone sells to.
That's blunt, but fair.
And the alternative is boring. Automate contributions, rebalance, ignore noise, focus your intelligence on skills and income growth where you actually have control.
Rule 4, leverage. This is where the casino analogy gets sharp. Leverage can multiply gains and losses.
Leverage is a tool. Like fire, it can cook your food or burn your house down. The transcript uses a real pattern. Real estate with a mortgage is leverage. If you buy an asset with borrowed money, small percentage moves in the asset can create big percentage changes in your equity. That's why leverage creates fast wealth for some people and fast ruin for others.
Give a safe framework. How do you think about leverage without fear or bravado?
I use 3 questions. 1, if my income drops for 6 months, can I still carry the payments? Not probably. Actually. 2, if the asset price drops 20 to 30%, can I hold without being forced to sell? Forced selling is where leverage kills you. 3, is the debt fixed rate or variable rate? And what happens if rates rise? Many people learn this the hard way when rates jumped. If you can't answer those, you're not using leverage. Leverage is using.
So leverage is not automatically bad, but it's not a shortcut either.
Right, and there's a second kind of leverage people ignore, lifestyle leverage. If your lifestyle inflates with your income, your personal balance sheet becomes fragile. A small shock becomes catastrophic.
That's the treadmill again. Higher salary, same stress, worse freedom.
Exactly. Freedom comes from margin, margin in time, margin in cash flow, margin in optionality.
Rule 5, psychology. This is where most people lose even if they have decent information.
Yes, because markets are not just spreadsheets, they're crowds. 2 core emotions drive crowd behavior: fear and greed. And your brain evolved to survive predators, not to allocate capital. That's why we get predictable mistakes. Loss aversion. Losses hurt more than gains feel good. So people hold losers too long and sell winners too quickly. Anchoring, we fixate on a previous price. It was 100, now it's 50, so it must be cheap. But cheap depends on value, not yesterday's number. Herding, we copy the group. So we buy late in bubbles and sell in panic. Confirmation bias. We seek opinions that agree with us, and we ignore evidence against our position. Overconfidence, a few wins make us think we have a system, when we might just have a lucky streak.
That's a lot. What's the antidote?
A written plan and simple rules. If you want one practical artifact, it's an investment policy statement, a 1-page document that says, what am I investing for? What is my time horizon? What assets do I own? How do I contribute? When do I rebalance? What will I do in a crash? Because in a crash, you do not rise to the level of your intelligence. You fall to the level of your systems.
Give me a sample rule set that a normal person could actually follow.
Here's a baseline. Rule 1, build an emergency fund first. You cannot invest well while living in a constant threat state. Rule 2, kill toxic debt. High interest debt is negative compounding. Rule 3, automate contributions on payday. This removes emotion. Rule 4, use low-cost diversified funds as your defaults. You can add complexity later, but earn it. Rule 5, rebalance on a schedule, not on feelings. For example, twice a year or once a year. Rule 6, keep a small curiosity budget if you want to speculate, 5% or less. That lets you learn without blowing up your plan.
That curiosity budget is good because people want to feel engaged.
Exactly. If you pretend you'll never touch a speculative idea, you might end up doing it secretly, impulsively, and too large. So give it.
Now, the pyramid role 5 in your map was hope-based players. The transcript talks about lottery. How do we talk about that without insulting people?
With empathy and math. Lottery is understandable. If you feel locked out of opportunity, a tiny chance of escape feels like oxygen. But the expected value is usually negative. It's entertainment, not a plan. If someone buys a ticket occasionally for fun, fine. The danger is when it becomes a strategy or when it replaces skill building, saving, and investing.
So the real risk is opportunity cost.
Yes, 10 euros a week doesn't sound like much, but over years that money could fund courses, tools, a small business experiment, or steady investing. Those have boring but real odds.
Let's connect this back to the levels. If someone is an earner today, how do they move up the map?
Great question. You move up by changing what you sell and what you own. For earners, the first lever is skill capital, skills that are scarce, valuable, and transferable. Not necessarily fancy, just useful. The second lever is negotiation and mobility. People underestimate how much wealth comes from a few career moves. Switching roles, switching companies, sometimes switching locations or switching niches. The third lever is ownership. That can be as simple as owning diversified equities, or owning a small side project, or buying a reasonable home when it makes sense without over-leveraging. The fourth lever is systems, automation, routines, and protection. If your finances are manual and emotional, your outcomes will be noisy.
Can we do a concrete story? Not a hero story, a normal story.
Sure. Imagine someone named Sam. Sam is a mid-level analyst, good at work, but finances feel stuck. Sam does 4 things over 2 years. First, Sam builds a 6-month emergency fund that reduces stress and prevents bad choices. Second, Sam learns a skill adjacent to the job that increases leverage. Maybe automation, analytics, sales, project leadership, or a technical certification. Nothing magical, just a targeted upgrade. Third, Sam changes jobs once, not for passion, for a meaningful pay increase and better growth path. Fourth, Sam sets up automatic investing with low fees and ignores most market noise. After 2 years, Sam isn't rich, but Sam's financial trajectory is different, less fragile, more optionality, and compounding finally has something to work with.
That's realistic, and it shifts the focus away from beat the market.
Exactly. Most wealth is built through a combination of stable cash flow, high savings rate, reasonable investing, and time. The market is one piece. Your behavior is the bigger piece.
Let's address the tension. People look at big institutions, bailouts, policy changes, and they feel powerless. What do you say to that?
I say you are not wrong to notice incentives, but don't confuse macro unfairness with personal helplessness. You can't control policy. You can control your exposure. You can build a buffer. You can avoid fragile debt. You can invest with low fees. You can diversify across sectors and geographies. You can improve skills. You can choose a long game. Those don't require permission. They require consistency.
So the calm approach is accept the arena, Pick your game and build systems.
Yes, and keep your identity out of your investments. If an investment becomes part of your ego, you'll defend it, not evaluate it.
Let's do a quick checklist. If someone listens to this episode and wants a simple next week plan, what is it?
Here's a 7-day plan. Day 1, list your fixed costs. Rent or mortgage, utilities, debt payments, subscriptions. You need to know your baseline. Day 2, calculate your emergency fund target. Choose 3 to 6 months of core expenses. Day 3, identify your highest interest debt. Make a payoff plan or refinance plan. Day 4, pick a default investment approach. For most people, that's diversified low-cost funds. Set a contribution amount you can sustain. Day 5, automate it. Auto pay savings. Auto invest on payday. Day 6, define rules for speculation. If you want it, cap it and write the rule. Day 7, choose one skill to develop over the next quarter, not 10 skills. 1, because income is a wealth engine too.
That's strong. Now I want to close by revisiting the casino metaphor. What should listeners hold in their head after this?
Hold this. The system is a set of incentives. If you don't choose a strategy, you default into one. The house edge is strongest when you chase short-term wins, pay high fees, use leverage carelessly, and make emotional decisions. Your edge appears when you build margin, invest simply, keep costs low, avoid forced selling, and let time do its work. That's not glamorous, but it's reliable.
I'll summarize in my words. Tell me if this is fair. 1, compounding is real, and it works on assets, debt, and fees. 2, inflation punishes idle money, so you need a plan for cash versus investing. 3, risk isn't one thing, and the goal is survivability. 4, information is uneven, so choose a game where you don't need an edge. 5, psychology is the silent killer, so you build systems to protect yourself from yourself. Fair?
Very fair. And I'd add one sentence. You don't need to outsmart the system. You need to stop letting the system harvest your impatience.
That's a perfect closing line for the passive path. Morgan, thanks for coming on.
Thanks.
And to anyone listening, keep it simple and keep it steady.